Alrighty, good afternoon and welcome to our highly anticipated One Big Beautiful Bill Act Implications, Insights, and Opportunities webinar. My name is Jessica McClellan and I'm going to be your moderator for today's session. Before we begin, just a few housekeeping items. We have roughly over 400 attendees, and we're asking that all participants are going to be placed in a listen-only mode to minimize disruptions. We kindly ask that you please keep your cameras turned off during this presentation. You are encouraged to ask questions at any time. Simply click the chat panel in the lower right-hand corner of your screen. We are pleased to have two of our senior tax managers, Chad Gates and Ruben Becerra. They're monitoring the chat feature, and they will be addressing your questions as they come in. This webinar is being recorded for your convenience, and we will be sharing that link along with the presentation materials in the coming days. Finally, we have invited you to participate in a brief poll to help us understand how you learned about this webinar. I'm going to launch that poll now. We really appreciate all your participation in helping us for future events. Okay, I'm gonna go ahead and end the poll. So let's begin. The newly signed One Big Beautiful Bill Act, or other as people note, OBBBA, brings significant implications for tax planning and compliance. It was signed into law by President Trump on July 4th, 2025. This comprehensive legislation makes some of the 2017 tax cuts permanent and introduces a range of new provisions that may reshape the financial landscape for individuals, families, and businesses alike. To help us navigate the complexities of this new law, we are joined by none other than Bob Bradshaw. Bob is a tax partner with over 15 years of experience at our firm and is highly knowledgeable in the nuances of the tax code. With that, I'm going to turn it over to you, Bob.
All right. Thank you, Jessica, and thank you all for hopping on today. Those of you that know me or have heard me speak know that I absolutely love taxes. And I appreciate the opportunity to be able to pontificate about this new tax law that Congress gave us on July 4th. There is certainly a lot in this tax bill, and we're not going to be able to get to everything today. So with that being said, we got two amazing, wicked smart individuals that are going to be able to help answer some questions. And afterwards, if you have any questions or anything like that, please feel more than welcome to reach out to us. We're more than happy to talk tax, and we just really enjoy being able to talk what this bill is going to be able to do for the community. And I know that I've said it a couple of times that I love and tax in the same sentence, and it's not how ironic that is to be saying, but it is truly impressive what this bill is going to be able to do in the short future and long term. So what I usually like to do when I start these presentations is kind of talk about where or how we got to this situation, like what brought us to where we're at, so we're able to then look forward and make sure that we are getting you into the best tax advantageous position. It's not always tax minimization that we want every year. I know I have a few colleagues on right now, and I'm pretty sure they just shivered when I said we may want to recognize income this year. But if we're able to take advantage of the current taxing situation and these unique things that this bill is going to bring to us, it could mean that we recognize income this year, next year, stuff like that, just to maximize your tax impact, so it minimizes as much as it can be. So we know that we're under the 119th Congress, and this is the 21st law that they passed this year. It was passed by the House, Senate, and signed into law using what was called the Reconciliation Act, or what referred to as simple majority, meaning that we didn't get any Democrats to sign this bill. Now, this is not uncommon. This has happened in almost every presidency. Biden had it with the IRA bill that he passed. Trump did it with TCJA. Obama did it with the Affordable Care Act. So this is a commonplace that we're kind of seeing right now. But what makes this one a little unique is how large it actually or it is for the individuals and businesses. So what I mean by that is that there are some provisions which we're going to jump into really soon here that are going to help taxes on your business side. Whereas on the individual side, why this may be the largest tax bill that we see since 96 or 86 reform, it may not actually feel like it's a tax cut, mainly because of the expiring TCJA that is set to expire at the end of this year. When they passed that bill back in 2017, they had to have a lot of things that sunset or expired to get it across the $1.5 trillion threshold. Well, that meant that pretty much everything that was individual was set to expire. Well, we're now up against that date, and they've now passed this OBBBA bill, which basically makes it permanent for all of these individual tax positions that we have. So therefore, while your tax rates are still the seven tax rates that that cap out at 37% this year and next year, where there's no cut, it does affect you if we didn't get that, because most likely businesses would have seen somewhere around a 10% hike in taxes across the board. So with that being said, let's kind of jump into some of the more meaningful provisions that are out there in this. And one of the biggest things that are probably coming out of this is what's referred to as bonus depreciation. Call it immediate expensing of assets, call it 168K, call it whatever you want. We've had some sort of iteration of bonus depreciation since 2001. It got put into place because of 9/11, and Bush put it into law to kind of re-incentivize the economy and get it jump started again. At that point in time, it was 30%. Over the years, we've seen 50% on new assets. Then it went to new and used. At one point, it was 100%. Then it went back to 50. And then this last iteration that we've had under TCJA has been at this 100% amount up until 2022. And it's starting to then get phased out over the next 5 years or whatever at a 20% increment. That meant that in 2025, we were at that 40% threshold of being able to bonus it. The residual 60% was going to have to be depreciated over its useful lives. Well, in this bill, they've now made bonus depreciation permanent after January 19th. So if you purchased your assets pretty much outside of the first 19 days of this year, we can now immediately expense those in the year we want, meaning this year, or we can go ahead and not and take them over the normal class life. This is a great thing for many businesses. You'll hear me say throughout this presentation that I think that if you spend the tax dollars to purchase something, you should also then get a correlating deduction for it. Just my 2 cents is you spend a dollar, you get a dollar deduction, but Congress didn't always think that way. It's kind of nice that they finally got there with this immediate expensing. If you purchase your assets in the first 19 days, unfortunately, there's not much we can do with bonus depreciation. There are other things we can do, Section 179 and other items that we may be able to take advantage of it. But the law is pretty clear with that first 19 days. It says if you purchase it and you have it as your asset, it is subject to that 40% limitation. It's not the placed in service date, which many of us would think that would make the most sense. Hey, it's placed in service. No, it says once you have that asset, you purchase that asset. And why I'm making that a big deal, even though it's 19 days, is the other thing that they also threw in there is this qualified production property for manufacturers. So if you're in the manufacturing industry and you're expanding and building a plant, and you start after that date, January 20th and before January 1st of 2029, we are now able to immediately expense the building portion of it related to the manufacturing facility. That does not mean the sales rooms or the offices or cafeteria qualify, but anything which is related to that manufacturing portion of it can now be immediately expensed, as long as it's an integral part, it's built in the United States, and it's new build. it does, and also has a place in service date of December 31st. So you actually get a little bit more time to actually place it in service. So that's why it is imperative, if you're part of that build process, and understand that if you are signed into a written bound agreement before January 20th, we may not be able to get to the manufacturer or immediate expensing. That said, and you'll hear me say this a lot, we are still waiting on the IRS to give us some more guidance on this. We have the base of how it's going to be rolled out, but Congress pushes a lot to the IRS to help us understand some of these things. So all in all, like I said, I think that this is one thing that's probably going to affect most people on here today, is the ability to go back to immediately expensing of our assets. If you are familiar with interest expense limitation, the 163J, you know how painful it's been for you over the past couple of years, because as I mentioned, to get TCJA across the line is when they introduced this limitation on interest, and it was you can only take up to 30% of your interest expense against up to your taxable income. So you take your taxable income times that by 30%. Anything below that, you could expense your interest. Well, starting in 22, they needed to repeal the depreciation and amortization portion of that, meaning that if you had $1 million worth of taxable income and you had $1 million asset you purchased, you would think that your net income would be zero. But if you had any interest on your books for that, it would actually not be zero. You would have to do a formula calculation and end up paying tax even though you're at a net zero position. They've gone ahead and reintroduced that depreciation and amortization allowance. Why that's so huge is because of that bonus depreciation. Now you're not going to be limited under your 163J, and you get that full bonus depreciation. Again, I think this is a great thing because, again, if you spend $1, you should be able to deduct $1. Just my thought process. The interesting carve out is we used to be able to capitalize the interest and avoid the 163J rules. However, starting next year, we're not going to be able to capitalize the interest and get away from 163J. It's still going to retain the 163J taint. So that means that you're still going to be subject to those limitations. However, with the depreciation, it's probably not going to be hitting too many people, and there are certain ways we can work around it. All right. Research and experimental expenditures, code section 174, the bane of my existence over the past 4 years. This came apart because of TCJA revenue generating to get it across the line. They needed something to help get it over that line and keep it underneath that 1.5 trillion budget. So what they said was, hey, starting in 2022, you're going to have to amortize your research expenditures over a 5-year period instead of being able to immediately expense them. So the hard part is we didn't know, we as a community, CPAs and the IRS didn't know what 174 expenses really were, because since the 1950s, the law read saying that you can go ahead and expense them under code section 170 or 174 or 162. You got immediately expensed either one of them. But now all of a sudden they're going to define this new code set, or not new, but they're going to make us have to capitalize these code under 174, which we didn't know how to do. In fact, it took the IRS 8 or 7 days until the filing deadline of the return to finally tell us what 174 costs were, what they thought it was. This was put in with the thought process that it was going to get repealed over with Congress. It didn't happen. So those of us that have been affected by it know that we've had huge costs that have been capitalized and amortized over the past 4 years. 3 years, then we have this year being our 4th year. Well, now we get the ability to expense it immediately. We're back to that expensing ability. And on top of that, they've introduced the code section 174A, which allows anyone who is under $31 million of gross receipts to go back and amend those returns that you had to capitalize and amortize those under. So if you look at your 22, 23, and 24 gross sales, if your average is under 31, we have the option to go back and amend. We don't know exactly how to implement that quite yet. Is it a 3115? Is it just a one pager like we did back in 22? Not quite sure. Need IRS guidance on there. But this is going to be massive for a lot of taxpayers because again, this just pushed many of you into the highest tax brackets immediately for those years. However, one thing that they didn't do or didn't address is what happens to the distributions in those years that you took to pay this tax. What I mean by that is just let's just say in 22 you made $1 million. You would do a normal 30% tax distribution, 300,000 out, you pay your tax, everyone's happy. Well, because of this 174, we would have capitalized at say $4 million, taking us to $5 million of taxable income. Therefore, you do a $1.5 million distribution to pay the tax. Well, all of a sudden, I go back, we amend your tax returns, dropping you back down to $1 million. Well, now all of a sudden, we have $1.5 million of distributions on $1 million worth of income, and we can get distributions in excess of basis. There is no provision that says, hey, once you get this money and you can put it back, you can restore your basis. That's what I would have liked to see in this bill. Unfortunately, it's not there. So why this is still a fantastic opportunity for many of you that are under the $31 million. We still need to walk through the numbers to make sure everything makes sense. It probably will. Haven't come across a case quite yet that doesn't make sense to go back even with this excess distribution amount. But it's just something to know and to keep in front of mind as we're going back. Now, anyone that's above $31 million and or that does not want to go back and amend, we get an option to either expense all of that this year or expense it over a 2-year period, meaning this year and 2026, half and half. This, again, the Congress doesn't seem to want to consult with me. Not sure why, but this would have been more beneficial if they also gave us the option to continue amortizing what we had and just go back to immediate expensing, kind of like a cutoff method. And the reason why I mentioned that is what's going to happen for 25 for many taxpayers is net income is probably going to plummet from a tax spot, which sounds fantastic, and it is. But the issue that I have with it is I mentioned when you're back in the 22 and 23 tax rates, or years, you were paying at that 37% rate or 29.6 if you got QBI or whatever your rate was, you were at the highest top tax rate. Well, now all of a sudden we're going to be going through to 24, to 22, the 12% tax brackets and taking deductions. So there's a permanent tax loss for you. So one of the things that we want to really do, and what I've already talked to some of my clients about, is I'm already talking to them about Roth conversions. How can I create income this year to take advantage of this huge expense that we're going to be able to push through? Because 4 years worth of expenses is going to almost have to push in negative. So we're looking at that, really the half and half type thing. Call it the Arnold Palmer if you want, but we're going to take half this year, half next year, and do our rolls of our IRAs. Great opportunity for a lot of taxpayers out there, especially. I know we got a lot in the traditional bucket. If we can get that over to you in a Roth bucket using the 174 expensing, and now all of a sudden you get all those tax dollars and retirement tax free, it's a huge, huge save for you. This is a nice little thing that they did make permanent. QBI is the 20% exclusion that we've got on all pass-through income. So if you're a partnership or if you're an S corporation, you qualify for the 20% deduction, subject to certain phase outs and limitations, SSTBs, et cetera, et cetera. This isn't new. We've had it since 2017. And the reason why they put it in is because they cut that corporate tax rate from 35% down to 21%. And because of that, we could not keep the top individual tax rate at 37%, or we would have seen a mass exodus of all building or all pass-throughs going to corporations under that 21% tax law, because 21% plus a 15% dividend, you're at 37 at 37. So I mean, it was just, or 36 versus 37. So you're right there. So what they wanted to do was incentivize these pass-through businesses by allowing that. So now that's made permanent. It's going to be there. They've also increased the phase outs, 75K and 150. One thing I don't understand quite yet, haven't got my head wrapped around, there's now a new minimum deduction of $400. Don't ask me why they did that. All you would have to have is $2,000 of qualified business income to get $400, but it's there. The software providers will catch up and get it there, but it's just one of those unique things they throw in these bills. Speaking of unique things, uh, I want to touch on qualified small business stock, QSBS. Now, this is probably not going to apply to most anyone on this call for the current law that they just changed, but the old law still is in effect. And what it does is it's this code section, it's 1202, that allows you to exclude the sale of your stock from a C corporation up to 10 million, now $15 million if you acquire the stock after July 4th. Your assets can't be above those thresholds I have on the screen there. And on top of that, if you start to acquire your stock as original issue stock, uh, you get a shorter period, you still get that exclusion. You get the 50%, 75%, and the 100%. As I mentioned, this has been around since 1993. We saw an expansion of this in 2009, 2010, actually going to the 100% exclusion threshold. But the issue was the corporate tax rate at 35%. But then TCJA came along and dropped out to 21%. Now, all of a sudden, C corporation with the exclusion could make a lot more sense. No longer is it that simple. Yep, your operation company is going to be an S corporation. Your real estate's going to be in a partnership. We don't get that as a simple structure anymore because we got to think about what are the long-term plans? How long do you plan to have it? And as most of you guys are on here, and you guys know that I'm on the TAS, that's the transactional advisory side, on the tax side of it. So I head up the tax department. Most deals are not stock deals. I completely understand that. However, this does apply on liquidation. So if you are a company, maybe that invests heavily in the capital, capex, and you have to manufacturing business here, you can pay your tax at 21% over the course of the business, and then get all that money out tax free, assuming you're not taking dividends and stuff like that out through the course of the business. Now, it is just one of those things that is just looking more and more enticing. However, this doesn't apply to any of the professional services, lawyers, CPAs, stuff like that. Obviously, because we could manipulate numbers as what the Congress feels like. But it is just a great opportunity, especially if you're not banking on taking the cash out immediately. If you're going to allow it to grow, we need to be looking at this for you. Some other provisions that are out there, finally, on this 1099 reporting, starting next year, it's going to be $2,000, not the $600 it is for the remainder of this year. Those that know me, 1099 reporting is just laborious and will waste the time most of the time. I understand why we have to do it. Thankfully, we got a little bit of an increase. Hopefully, we keep seeing a nice big increase on that. Again, you have to report all your income under Code Section 61. This is just a reporting nightmare for a lot of us, and like I said, time consuming. Additionally, another nice thing that they did was this 1099K. I call this the Taylor Swift rule. Basically, what happened is I think Congress heard about how people were buying all these Taylor Swift tickets and then reselling them and making a lot of money off of them. Well, they were trying to drop this down to that 600 threshold where think StubHub, stuff like that, Ticketmaster, where if you were selling on there, then you would get this 1099K and you have to report it. More importantly, think Venmo. If you go out to dinner with a group and all of a sudden we forget to check the box that it's personal, you're going to get this and then you're going to have to report it on your return. So this is where it's at now. And they did build into the actual tax law or tax form a way to report this if it was personal. So if you ever get one, not a big deal. I hope never to say these four letters again. There's more ERTC penalties. This thing, the IRS is continuing to crack down on this. But hopefully that's gone. It was great for a lot of people out there. Unfortunately, some people did take advantage of it, but I know people that it did benefit. It helped out greatly. This one I do want to spend a little bit of time on, excess business loss limitation, section 461L. So this was put into place under TCJA, and it was meant to limit the amount of business loss you're allowed to take to offset your other income. So think of like you run in a business and your spouse working another job where she's making a lot of money and then you lose a lot of money at your job. They don't want you to offset the wage income similar to like the 68 reform, 86 reform of the passive loss rental doctor W-2 wage type thing. So they set these limitations at 250,000 for single 500,000. I think it's somewhere around $600,000 this year that you can't or your business loss is limited to. Why do I want to focus on this? Is A, this was in the TCJA, it got extended under the IRA under Obama, or not Obama, Biden. And therefore, we do see that both sides of the aisle kind of like this one, and it just got made permanent. So I don't see this one going away ever. On top of that, I had mentioned, hey, let's look at your bonus depreciation and your 174 deductions and possibly 163J to create huge losses this year to do big Roth conversions. Well, that's why we may have to do that 2-year rule is to, because if we get too big of a Roth conversion this year, I don't want everyone running to their financial broker and saying, hey, I'm buying this $2 million piece of machinery and Bob told me I can do a $2 million rollover. Not quite, but it is definitely ways that we can plan around it and just know that this is out there. But we, like I said, it's just something to just keep on your radar as you're calculating how much Roth and stuff like that you're going to get into. This last topic just always amuses me. So, like I said, it's 940 pages. It took a JD Vance to actually break the tie at the Senate to get this even through the Senate. So all of a sudden, you're going to see some provisions here that just are like, how did that get in there? Well, we kind of know why. So this one, this made me chuckle. This is the business meal exception for fishing operations for those that are above the 45 longitude line. For those of you out there that are deadly as catch fans like myself, you know that this pertains to the crab fishermen up in Alaska. So they put this in there that the meals that they consume on the boat are now 100% deductible. I'm guessing 2 senators pushed for this, and that was the only way to get this across the finish line. It just amazes me some of the things they put into these bills. All right, jumping over to our individual taxing situations. I'm not going to spend too much time on these two, mainly because these have been the hot button topic. The news has been reporting on them and covering them pretty much, but I will touch on them a little bit. So the tip exclusion, it's in here for the next 4 years. It expires at the end of 28. It's a $25,000 cap. It starts phasing out at 300,000, but you're going to be able to, as long as it's reported on your W-2, you're going to be able to exclude up to $25,000. This is what we call a below the line deduction, though. It's not an above the line that you would normally typically see with your adjustments. This is going to be below the line. Why is that important? Is a lot of things are built off of your adjusted gross income. A lot of limitations come off of when we calculate adjusted gross income. This is below that line, meaning that your adjusted gross income will include this 25,000, but you will not be capped on it. Additionally, like I said, it's got to be reported on your W-2. And the IRS has to come out with what are your occupations that customarily receive tips. This makes me think of that Simpson episode where Homer had to sign everywhere he went. He just kept seeing a tip for this, tip for that. Could you imagine having to go to your grocery store and all of a sudden you see, and now I got a tip for this as well? So they're going to come out with a practice or a list of, hey, these are the ones that typically receive the tips, and these are the occupations that we're going to allow them to get the tip exclusion of income. That being said, there's also this overtime exclusion. This is the one that I personally did not see happening, getting through. I could not figure out how they were going to regulate it. But here it is, and here we are. This is great for a lot of hourly workers out there. It is the same time frame this year all the way through 28. We get that 25,000 up to 25,000, still subject to Social Security and Medicare. Your W-2, it's got to be reported in W-2 as usual. So for all of the employers out there, there's going to be probably a new box out there for us to put in how much overtime they actually got. And since it has to be reported on your W-2, those that work multiple jobs and could be up to like 60 hours, 70 hours a week, unfortunately probably won't be able to qualify for this because it's not going to be reported on either W-2 in the appropriate box. Additionally, this is defined by the Fair Labor Standards Act, I think number 6 or whatever it is, of what an employee is and all that good stuff. For those of us that are salary out there, most likely not going to be able to qualify for this. We'll see what the IRS says. But mainly it's going to be those hourly workers that will be able to exclude the $25,000. All right, standard deductions. So this is the amount that every person gets, depending on your filing status. So you can find your filing status, married, filing, joint, and singular. Two most common, so those are ones I'll talk about. But you can kind of see where it was about to go to after next year, that pre-TCJA, $12,000 where we're about to go to in 26. And now we're at 31.5 for married, filing, joint. It actually got a little bit of a bump under than what TCJA had, which was kind of nice. And I didn't expect that at all. And so this is what you get to exclude. Anything above that is where you start calculating your taxable income. Then they also introduced this additional $6,000 for anyone who's 65 and older. This was put into place because of the Social Security exclusion that Trump ran under, that he was going to try to exclude Social Security. Honestly, I thought that was going to be one of the easier ones to fix. All you had to do was just lower the 85% tax rate down to wherever you wanted it, or make the phase out start at 150, whatever. So instead, they just have this additional $6,000 for anyone who's 65. So if you're married, filing, joint, and you're both over 60, 65 or older, you're going to get 12,000 plus that 31,000, which isn't too shabby. This also does expire in the next 4 years, so we're going to see this for a little bit of time. It's an underline, or it's a below the line deduction as well, so you don't need to itemize to be able to get this. But if we start thinking about the tip income, the overtime income, maybe even this, 65 and older, you start to see that it could be actually pretty meaningful for some of the middle class individuals. Because if you have one spouse that it gets tips, the other spouse that gets overtime, I got $50,000 of exclusion plus 31,000. So we'll see how this all interplays, but it could be really meaningful for a lot of people. All right, state and local taxes. This has been one of the hottest debated subject out there in the tax arena. And I always find it a little ironic that the thing that they debate the most is how you deduct the taxes that they're taxing you on. So they write the tax code, and then can you deduct it or not? Who knows? So what they have come up with is, for us that remember back in TCJA, the $10,000 cap. So you were only allowed to deduct up to $10,000. And then you needed your mortgage interest and your charitable contributions to get you above the threshold to be able to itemize at that $31,000. That meant the item, or people that were itemizing, went from like 70% up to like 94% of the people were claiming the standard deduction. Only about 6% to 7% of the US population was claiming standard, or were able to itemize anymore, because this $10,000 cap. Well, not only well, let me back up. So one of the things that many people have heard about and have worked through is what are called the pass-through entity tax. What this is that because of this $10,000, and if you're a business owner that owns a pass-through entity, this partnership or S corporation that I was talking about, you are now subject to state taxes, which you usually take on your individual return. Well, a workaround was by giving you a one-to-one credit on your individual return. And then in 2020, the IRS came out and said, you know what, we're going to allow the workarounds, and we're going to allow you to deduct it at the entity level. We're not going to challenge it as a deductible expense, and allow you to basically expense the taxes created by your state and local against federal income, getting a federal tax deduction, and thereby working around the 40% or the $10,000 threshold. Well, because of that, not many people were then hit with this SALT cap, unless you're in higher taxing districts like California, New York, New Jersey, that have high real estate and high income tax states. Now, so Ohioans, we get hit with this city tax, but a lot of people may not have been hit with or hurt as bad. So that's why there's still this cap, and it's not repealed as wide, because it's not because there's some opposition to it. Now, what's interesting is this new cap is set at $40,000. That means that anyone who can get to the 40,000 is going to start itemizing again. That means that 94% that took standards probably going to drop somewhere in the 80s. So a lot of you that are listening today may start itemizing again. Why is that important to mention? Well, that just brings back the importance of year-end tax positions and tax planning ideas. We're going to now have to think about when we pay our real estate taxes, December 1st or 31st, January 1st, stuff like that. Also, how do we group our charitable contributions? Should we be looking into things that are like a donor advised fund that allows me a deduction this year and then dispenses it out in future years? Or a mortgage interest, where am I at? Stuff like that. So that is going to be an interesting thing that's going to affect us at the end of this year. But one of the main questions I get asked a lot is, hey, Bob, you've mentioned that qualified QBI deduction of 20%. Wouldn't it be smarter to take my state taxes, put it back in here, and then get a higher QBI deduction, effectively lowering my tax? And all the numbers that we've kind of ran here, we haven't really come across a situation. I mean, there's probably a few people out there that it could be for, but most of us getting that pass-through entity tax deduction on your business return is going to be still more beneficial, because you have to first get to the $31,000 threshold to be able to itemize. Then you only get it up to 40,000. So then if you're above 40,000 in that, you get capped. But more importantly, or the thing that I've really been seeing, is the phase out. It's not everyone gets this 40,000. It starts phasing out at $500,000. Once you get above $500,000, you don't get this cap limit anymore, or you start phasing out. I think 600,000 is where it's at. So like I said, it's that usually limits the ability to move that PTE over. Now, the good news is, like I said, we can address all this during tax planning and projections to see exactly where you're going to come at, because most states allow the pass-through entity tax as an annual election versus multi-year election. So it does increase 1% over the next 5 years or whatever, and then it will drop again until 2030. So we'll be talking about this for the years to come, and most likely again in 2030. Oh, one interesting thing I forgot to mention is on this pass-through entity tax, or there's notice. Ironically, the notice is a notice that says they're going to issue regulations. Not that we can actually deduct it, but they still have yet to issue the regulations that allow us to deduct it. But more importantly, the House bill. So when they passed this bill, to meet that January 4th deadline or July 4th deadline, what they needed, unfortunately, or what was unique with this bill is the House put out their bill, the Senate put out their bill, and then usually it goes to committee and they negotiate over to make the two bills align. Well, what happened was the House put out their bill, the Senate put out their bill, and because they were so close to the July 4th, the House adopted the Senate bill in whole cloth so it could get on President Trump's desk by July 4th. Well, that means that anything that was in the House bill not necessarily made it in the Senate bill. One of those things was the repeal of the PTE tax. We're still allowed to do this. It's still a great opportunity for a lot of us, but it does bring up interesting things for future thought processes about how the House and the Senate are going to talk about PTE tax going forward. I've mentioned interest deduction a couple times now. Not too much has changed along this for the itemizers. The mortgage interest is still at that 750,000 limit. It was set to go back up to $1 million at the end of the year. That it's now 750. They did add back mortgage insurance premiums as deductible starting next year. This got repealed. The PMI deduction got repealed back in 2017. However, across the years, there had been extender bills that extended this, and then I think in 22 it dropped off. So now all of a sudden, starting in 2026 again, anyone who's in PMI are now can include this if they itemize. This next thing is what qualified passenger vehicle loan interest, deductibility on your individual returns. It was run on as a platform I don't know if it's going to affect many people. Hopefully it does. I just don't see it with the phase out being so low. $200,000 seems like too low to phase this out. But basically, if you buy a brand new vehicle and you get a brand new loan after December 31st, so existing loans do not qualify, assembled in the United States, that's easy to find out. You just take your VIN, you drop it into a website, it lets you know if you did or not. But you can get up to a $10,000 deduction of the interest against your income, and you don't need to itemize for this. Again, I don't know many people, because that phase out seems a little too low to me, but hopefully it's out there and helps a lot of people. Charitable deductions. So we had this during COVID timeframes. Those may remember you got $300, and the following year you got $300 per person, so you got up to $600 above the line deduction for charitable contributions. Well, starting next year, they are going to allow for deductions against your income if you don't itemize of 1,000 or 2,000, depending where you're at. It's below the line, so it doesn't affect your adjusted gross income. But why it's important is it does help out all these charities that got harmed because you no longer were or received a tax benefit for being able to contribute. So I only see this as really helpful out to charities. So if you were to give $100 and you got it in 24% bracket, your effective rate, or you could give $124 effectively. Well, when we went to standard deduction, you could only give 100. So hopefully this can re-incentivize to give to those local charities again. Then counterintuitive, they did establish a new floor on charitable contributions for those that itemize of 0.5% of adjusted gross income. That starts next year. So system's going to be able to calculate that. That's going to be, but it's just a little weird that they did that. My guess is that they needed something to get across the finish line. Then on the other side, they went back and then established a 60% ceiling. So that was set to drop down to 50%. So you can only give up to 60% of your income. That was set to, like I said, drop to 50 starting next year. So it's kind of nice that you're not going to be limited by that if you're in a position that you're philanthropic, or maybe you don't have a lot of income, and you're not going to be harmed by that. All right, child tax credits. The other thing that has been highly debated over basically since 1998, when they came in about, when we had a surplus, is this child tax credits. The new bill establishes this amount to be $2,200. It's adjusted for inflation for the first time ever. The refundable piece has been adjusted for inflation, but now the actual credit is going to be adjusted. It still has the phase outs, still have 500 for non-qualified or qualified dependents that are above 17 years of age usually. But what always just fascinates me on the child tax credits is we actually seen a bill a couple of years back, 23, I think it was, that was going to fix 174. However, the GOP controlled Senate voted it down because it was refunding too much of the child tax credits. So the 174 meeting expensing got tabled, and now we're here with the credits where they're at. Not that it means anything, but it just fascinates me how much this child tax credit plays into the adoption of tax laws over our courses. Great news across the board, I guess, for everybody with dependent care, adoption credits. There are just some amazing credits out there now that are bumping it. Starting next year for the FSA, you can get that higher limits. You said dependent adoption credits now $5,000 refundable to you. Before it was a non-refundable credit. Trump accounts, honestly, just starting to dig into those a little bit myself. Kind of let the financial advisors kind of run with this on their sides, their whizzes when it comes to this stuff. Basically, what I'm seeing though is it's not as attractive as it was intended, only because it could come out taxable, where you still have your 529 plans, still really, really attractive plans out there. All right. Some other things that have happened in here is the casualty loss rules now allow for state declared disasters. This is fantastic because prior to this, it had to be a federally declared disaster. Well, now if your state you're in a disaster zone, you can now get your casualty losses. Because prior to this, you're not allowed to take the casualty loss. Wagering losses, this is one's kind of unique, is that no one's really sure how this got into the tax bill. and they're trying to figure this one out. But basically, what it does is it limits your losses to 90%. So let's just say you go to Vegas, you win $100,000, you then lose that same $100,000. Because of Code Section 61 that I mentioned earlier, you have to report 100% of that as income. Well, this new law limits you to only 90% of your losses, which would be $90,000. Therefore, you have $10,000 worth of phantom income that you have to report, even though you don't have it in your bank account. This is already seen a new bills that are being put out to try to fix this. It's funny to me that many of the Congress people didn't even know this was in the bill. But this is something that's probably going to get fixed. And I should have mentioned this probably at the top is when TCJA got passed, we've seen it somewhere around 88 provisions or changes to that law since it got enacted. So because of how massive this is, I'm sure we're going to see some changes along the way down the path. But all in all, this is one of those things that I know that probably needs fixed because it just doesn't make sense for a lot of people out there. Section 529, I kind of mentioned that a little bit ago. They've just expanded the eligible cost. This is fantastic. So now you can use it for books and et cetera, et cetera. It is just a great opportunity if you want to save for colleges. Now we have more opportunity to use those expenses, so you're not limited. And then we still have the ability to convert it and roll it to Roth IRAs and stuff like that down the road. So just a good planning technique that is out there. Fees limitation. So this one got put into, well, the P's limitation has been permanently repealed. So those of us prior to 2017, 2018, I guess, remember that if you made too much money, you were subject to a limitation on your itemized deductions. Well, they've permanently repealed that and replaced it with a 237th reduction. What that means is if you itemize and you're in a top tax bracket of 37%, they're going to see a reduction of your itemized deductions by 237ths, effectively meaning that you're getting a deduction of 35% versus the 37% you recognize it, or that 2% arbitrage you're going to pay tax on. You're not going to be able to offset it as you normally would have been in prior years. Obviously, it's not too big of a deal, but it is still meaningful, especially those that are getting into that 37% tax brackets that are getting a reduction. It's no longer one for one across the board. And then you got that charitable contribution as well. So we're going to see some interesting tax plans coming up this year. Speaking of some other things that they did do, they have permanently repealed the personal exemptions. We were entitled before to get a $4,000 deduction for every qualified person. Those usually got added back in AMT, which I'll talk about in just a second. But those are now permanently gone. The reason being is that new standard deduction is so high, it effectively does the same exact thing that they were trying to do. Moving expenses, except for active duty, those are gone as well. Therefore, if you get paid to move jobs or something like that, you're going to have to pick that up as wage income. It makes sense across the board. Is what they're trying to do is limit the things that they think employees take advantage of. The meals, like you said, we have nothing on here, meals and entertainment, because those things have already been limited. This is just another way to keep those qualifying expenses as reportable. One of the ways they're paying for this bill is by the repeal of the clean energy credits that were in that IRA bill that I've mentioned a couple times. So a lot of your home energy credits and those vehicle incentives, anything basically green, are going to go away next year. So my recommendation is if you're thinking about replacing anything in your home or anything like that, this is the year to do it. If you don't get it done this year, you may not be able to get any credit for it. And I believe the vehicle credit one actually expires September 30th. Another thing that they did do was they did permanently repeal the 2% miscellaneous expense deduction. So this is the thing that used to be like your CPA bills, your attorney bills, your safety deposit box, anything like this that we used to be able to expense, your unreimbursed business expenses, stuff like this that we are able to then take against your income effectively if you were an itemizer. Well, now they've effectively removed that. You cannot do it. But what was unique about it, we were expecting that, but we didn't expect is they removed or actually they inserted a new definition for unreimbursed educator expenses. So before that would be considered an unreimbursed business expense, not deducted or subject to 2% limitation. Well, now it's a special carve out. That means teachers, coaches, anyone that's associated with the school systems, basically K through 12, can now list out the full amount of their expenses. And assuming they itemize, they can now take the full amount. They are no longer subject to it, and it's just going to be one of those separately stated line items. So they're finally understanding that the educators spend more than $300 a year on expenses. So I think all in all, a good thing there. Alternative minimum tax, I don't want to spend too much time here, but basically this is the heads they lose, tails you, or no, I'm sorry, so that backwards, heads they win, tails you lose scenario. The great news here is they did include the exemption phase out it doesn't start to $1 million. Anyone that is familiar with AMT, it's a flat rate at 26%, then jumps to 28%. And once you get to a certain level, because of how our tax brackets work, most people are not subject to AMT anymore. The only ones that will ever be subject to it really are those that get capital gains in excess of $1 million. Capital gain rates did not change in this bill. They don't look like they're going to change. So 15 and 20% are going to be there. And if you're above that $1 million in cap gain rates, you could get hit with that add back because you start phasing out the exemption. But besides that, alternative minimum tax is pretty much dead across the board, which I know as a tax professional, I'm pretty happy to see that one go away. Estate and gift tax, I don't want to spend too much time here, but it is important to note that they did keep the new limits that were established under TCJA. They did not sunset or drop down to about the $7,000 threshold that we were originally thinking that was going to happen, because the way the bill was written, this was supposed to in 2026 drop down to 7 million, give or take, for the inflation. So we did a lot of tax plannings and estate plannings over the past 8 years to get us into a position to prepare for this drop down. Well, now this $15 million threshold is made permanent, still going to be adjusted for inflation. We still have portability. I'm still a fan of filing for portability. We don't know what the next Congress is going to bring in. We don't know who's going to be in office in 2030, 2034. So if we elect portability, just makes us look better if should they come back and try to repeal the estate tax. But what's most important, and what I wanted to touch on this real quick, is that it does make us want to revisit our estate planning and particularly our trust and what trusts are in our estate and which ones are out and those irrevocable trusts. Because again, over the course of the years, we have done a lot to be worried about that taxation of it upon your death. Well, if you're at these $15 million, $30 million, if you're married, you're probably not going to have your assets above it, or at least the majority of the people will not be above it. So maybe not taxes is the main motivator of the trust and estates anymore. Maybe we want those assets with lower bases to be included in our estate. So when we die, we get that step up in basis. It's just something that, hey, now that we know we have some permanency, it's definitely worth kicking the tires on and looking at again, just to see kind of where we're sitting on it. So overall, I know I threw a lot at you. There's a lot in this tax bill, and there's certainly a lot more to still uncover as we're fully understanding the impacts of all of these things. We're going to be putting on another seminar later this year that's going to be specifically addressing all of the things for 2025, along with this, things to think about before as we're moving throughout the year, is just the importance of tax planning. We can get started on that now because, again, that SALT deduction is going to make pretty much a lot of us be able to itemize again, and the timing of that. More importantly, that interplay with Section 174 and bonus depreciation and your ROS that we can convert to save you true actual tax dollars is going to be monumental. Additionally, the ability to go back and amend for the 174. I know I've talked to a few of my clients out there and continue to have these conversations. We're ready. We're waiting on the IRS to see what they're going to do. I think they have until September to give us guidelines on stuff. So we're still waiting on them. And then, as I just mentioned, kind of revisit your trust to see exactly where you're at. So I think that's all I had.
Yeah, thanks, Bob. We really appreciate it. This concludes our webinar today, and I'd like to thank Bob for joining us. I'd also like to thank everyone that joined us today. The presentation materials, including the recording of the webinar, will be made available to you in the coming days. In addition, we've developed a one-pager. It's a quick reference guide to kind of look over, what happened prior and what is currently happening now. It's, we can look at it from the business and the individual side. That will also be included as a link in your email. So please keep an eye out on your in your inbox for the correspondence from us with that information. As Bob mentioned, we are planning another webinar featuring the latest updates and guidance. And that webinar will also offer continuing professional education for all you people that like to get CPE. So stay tuned for those further details, and we'll be sharing those with you shortly. We appreciate it again. Thank you.